Hi, good morning everyone. I'm really delighted to be standing in front of you. I want to spend the next 20 minutes talking to you about the crypto economy, but I thought it would be helpful if I just start with a bit of my background, so that way you have some context on why this industry matters. I graduated from Wharton in '91, and in 1991, Dean Palmer had told our graduating class that you need to create your career every 5 years. And I've been working for 25 years, and unfortunately, I've actually had the same job for 25 years, so I didn't listen to him. I've been doing research, and I've worked at various firms. I started off at Kidder Peabody, then Salomon Brothers, then JP Morgan, and in just the last 3 years, started my own research business. Now, the reason I'm telling you this is research is a pretty unique business. Number one, we work for our clients. We don't manage capital. We don't invest capital. Our clients own our business. But it's also built on trust. And that trust is important. I still have clients who've been with me since 1993. I might have bankrupted them 5 times, but they're still paying me. But the reason they've followed me all these years is that there's 3 foundations to our work. The first is we do analysis, not opinions. So the presentation I'm going to give you really just provides some analytical framework, and you can form your own opinions about what that means. The second is we tend to focus on things that we can see a mile away. So we're long-term oriented, or as you say, we're long-term greedy. So we don't try to find things that are only going to work for 2 years. We try to find things that could even last up to a generation. And the third is we are often contrarian. And I think crypto assets has been a remarkably contrarian field. I've never seen our clients disagree with us so strongly on this. And I think part of this has to do with the fact that the formation of capital around crypto just hasn't followed past cycles. Cryptocurrencies like Bitcoin essentially needed $0 to start, so it didn't start with a venture capital or a private equity investment, and it didn't go public to raise more money. And I think because it actually has gone under the radar, it's created a lot of controversy. So there's 4 topics I want to speak to you about with regard to crypto assets. The first is really the idea of digital trust and why digital trust is important today. The second is that this is very largely a millennial phenomenon. So we have to keep in mind that the generation that is going to drive this asset as an asset class isn't really us and the people in the audience. It's really going to be our kids or those who are millennials today. The third is, I think crypto has already established itself as an asset class. So even if you don't think it's pertinent to your area of focus today, it's emerging as an asset class, and I can show you how its penetration of various financial channels is so small that this is, I think, in the earliest stages. And finally, I just want to show you 3 reasons why I think Wall Street is going to care. And remember, if Wall Street dedicates resources to this space, it's going to blossom and flourish and become a very important financial market channel. So these are the 4 topics I want to start with. Now, on trust, we tend to be very confident about the financial system in the US because, it works fairly well. But in a world that's increasingly digital, and if you look at the 5 largest technology stocks in the S&P 500, they're essentially all native digital businesses. Digital trust is increasingly important. The second innovation that's taking place today with blockchain, and the video covered that, is decentralization. And as we move towards a decentralized world, the question you have to ask is, does money have to be native in paper, or could we have a native digital currency? And the third is, I think we're starting to see a trend towards tokenization, or assets in the real world become native digital, and again, digital trust becomes important. Now, to give you an example of why centralized trust systems aren't working well, consider, you may not be aware of some of the high-profile incidents in the past year, but the Malaysian central bank recently wired $50 million to a hacker not realizing that this was a fake entity. So we know that centralized systems aren't necessarily working well in a native digital world. But let's look at how people look at trust in terms of government, because monetary systems are reliant on trust. This is a Pew Research survey, and the question they asked is, do you trust the government to do the right thing? The level of trust in the government is at the lowest levels in 50 years. So never has the average person more mistrusted the government. And again, monetary systems are very reliant on individuals trusting their government. But this is a bigger problem outside the US. This same survey question was asked outside the US, and the shaded area are the countries that trust their governments even less than the US. So we're looking at countries like Brazil, Argentina, South Korea, Italy, Greece. Not surprisingly, these are the countries where digital currency development is flourishing. So there is a very high correlation between the lack of trust in their government and the blossoming of digital currencies. And again, what we have to keep in mind, we're in the US. So the dollar, we're comfortable with the dollar being the default currency. Outside the US, many people would rather not have things denominated in dollars. Well, what about millennials? This is a Facebook survey done in 2016, and they asked millennials, do you trust banks? 92% of millennials don't trust banks. Now, part of that is the financial crisis. They saw their parents lose their homes. But it just shows you that millennials generally don't have trust in centralized systems. So again, I think one of the key themes and why it's happening today for blockchain is the idea that blockchain is creating digital scarcity and native digital trust. That trust doesn't exist in existing systems today. But I think a more important phenomenon, and I think something that is increasingly going to be studied, is how important the millennials are to financial systems. So we know millennials are a big cohort, and it's been important to advertising. But let me just sort of size this for you. Millennials are someone born between 1981 and 2000. And that's roughly 96 million people. That is the largest single generation ever in history. It dwarfs the baby boomers, which peaked at around 80 million. And in fact, Gen X, which is my generation, is so small that statistically, and I'll show you some charts, we actually barely move the economic needle. And in some ways, that's the reason why economic growth has stagnated for the last 10 years. So why do millennials matter? Well, I think it's important for every generation to understand that they need to look at the world, if they're going to understand millennials, through 20-year-old eyes. And so I have an illustration here. For boomers, when boomers were in their 20s, they were Tom Hanks in that first picture. Okay, and that's from Bosom Buddies, or one of the photos. And as you can see, Tom Hanks has aged really gracefully, but he is no longer so Buffy. And Gen X, in their 20s, was Leonardo DiCaprio from Titanic. I was going to try to pick like a rock band, but rockers all look the same. They just got wrinkly, but they got the same hair. So you can see Leonardo DiCaprio again in his 20s. That's what he looked like, but today he's again a distinguished gentleman. And so what does a millennial in their 20s look like today? The midpoint I tried to pick was Justin Bieber, because he's in that spectrum of where sort of the cohort of millennials sit today. So the reality is, if you want to understand a millennial, you have to think what you were like when Bosom Buddies was on TV and you were 20, okay? So you really have to rewind the clock. And why does that matter? Well, let's think about how each generation experienced technological and social change. So the boomers in their 20s experienced women entering the workforce. There was a huge increase in the participation rate. The creation of mail order catalogs beyond Sears, so like Spiegel, et cetera, and Eddie Bauer, and remember all those catalogs? mainframe to PCs. I mean, this was, the generation that Apple was created in the IBM personal computer, and also Microsoft and graphical interfaces. Now, Gen X, which was my generation, experienced really two important disruptive technologies: wireless, which was analog cellular at the time, but it became digital, and it led to mobile email and text messaging, and of course the convergence with the internet, which is really powered the digital economy. Those two technological innovations, I was very fortunate to be the research analyst for. So during my years of 1993 to 2007, I was a wireless analyst. So I witnessed the growth of the wireless industry and covered it and helped the companies raise money, but also saw the convergence and collapse with the internet. So what do the millennials experience today? It's companies like Facebook, Uber, Airbnb, Instagram, Kickstarter, things that we all use, and in fact, we all are very comfortable with. But I'll tell you, if someone had told you in 1990 that there would be a $500 billion market cap company that would be simply you sharing your information with other people, and they would charge you no money, everybody in 1990 would say that's a failure. But that's obviously the Facebook model. So clearly, social media is a millennial story. But here's some other things on that list, as you notice. Blockchain is a millennial story. And I'll explain why I think that if millennials adopt this the way we think they are, this is not the internet bubble. This is a lot more like emerging markets becoming an asset class. I think that's really the appropriate analog. Okay, so let's just do a baby boomer illustration, just to understand why I think generational moves last more than 10 years. This chart is the Japanese stock market, the topics, from 1950 to 72. And it rose 40 times during that period of time. And that's a monstrous, monstrous rise. I mean, think about it. An entire country's stock market rose 40x in 20 years. Interestingly, that's 1972 at the top. That was the year Henry Kissinger invited Japan to the G7. So because the Japanese stock market nearly tripled in 1 year, they became a developed nation, part of the G7. And unfortunately, you can see that after that peak, the topics actually fell 50%. Now, you can imagine what this guy's parents were saying. Son, we fought the Japs during World War II. Why are we helping their stock market? They were in the middle of the Vietnam War. They just fought the Korean War. Why would anybody want to invest in these less developed countries? Now, in 1970, that's really when Templeton was formed, right? John Templeton, at the time, there were only 5 emerging markets he could invest in, but that was that moment. So let's see how that advice played out. Was it wise to say, let's give up on Japan? That chart previously is now in the middle of the page. Okay, that's 1972. The Nikkei rose for another 20 years to 1990. You had a 40-year rise in the topics with a 400x total return for a country. This is not, a 25-cent stock. This is the entire country's stock market cap. So the point is, it's a good thing that the boomers didn't listen to their parents, which was a silent generation. Okay, so let's think about where the millennials are today. The average millennial is 26, which means they're already starting to drink and they started to buy cars. And we've known that they've already transformed the alcohol market, right? There's a preference for whiskey over beer. And they're already transforming the automotive market. What you may not appreciate, millennials are also driving a huge revival in the RV market. The last time RV sales were as strong as they were last year, Lucille Ball was on TV. So it's been nearly 50 years since RV sales have been this strong. 44% of the buyers of the RVs today are millennials. Well, what are millennials going to be doing in the next 30 years? Okay, something you can see a mile away. I have a population tree here, and I've lined up each of the generations. The millennials are now just entering two critical periods, the home buying years and their investing years. So let's think about housing. I've lined up each generation when they were aged 21 to 35, and I colored each. The red is silent, the boomers are light blue, Gen X is gray, and the millennials are blue, dark blue. Housing starts have peaked with every generation's peak cohort size. This tells us housing is going to likely boom through 2030. So stay long housing, I guess, right? It's really bullish. But let's talk about investment years. Savings flow, okay, so the investment pool of prime income age earners is running about $1 trillion a year today, okay? So every year there's $1 trillion that the people aged 35 to 60 allocate. And today it's dominated by boomers and Gen X. But the millennials are now just entering these prime income years. So what did the silent generation do when they dominated the prime savings flow? They actually bought gold. Gold was $40 when we went off the gold standard in 1971. That was the first time individuals could buy gold. And when the silent generation cohort peaked, gold was $600, a 15x in a decade, just by a single generation buying gold. The boomers, we know, bought equities. What was the first year the boomers turned age 35? 1982. That shaded blue area is their first boomers to the peak size of the cohort, 1982 to 99. Coincidence? That was essentially the stock market boom. And the question is, well, what about the Gen X, which was a smaller cohort? As you can see in the middle period, the stock market didn't go anywhere. Gen X wasn't big enough to actually power the stock market higher. But here we think the millennials are going to drive equities. They like growth stocks, so we think it's going to power a stock market boom through 2038. Gen X liked hedge funds, and you can see that's essentially peaked with Gen X. But here's what I think millennials are going to do. Now remember, millennials are going to soon have $1 trillion of savings flow. Bitcoin's rise in 2016 coincides with the first millennials entering their prime savings years. Today, crypto, for every $1 billion that goes into crypto, it's turning into roughly $25 billion of price appreciation. If millennials put 10% of their savings flow, $100 billion, into crypto, that's a $2.5 trillion rise per year. And crypto is roughly a $500 trillion market cap. So we think that you may end up seeing Bitcoin by the end of the cycle as high as $10 million per Bitcoin. Okay, so I'm going to just walk you through why crypto is an asset class. First of all, the St. Louis Fed actually published a white paper, and they said that it looks like it is quite a viable asset class. And you might say, well, isn't crypto breaking all the rules that we know about? I went to Wharton. We had like the 10 commandments or evaluation, et cetera. But I think over the last 20 years, a lot of rules have evolved. It used to be that 92% of companies that went public had to make money. Today, only 20% do. We've already broken that rule. Private equity used to only be 1/3 of the public market. Private equity now is 84% of the public market. It may possibly be that in a few years, private equity is bigger than the public market. Bonds used to pay income. 80% of bonds in Germany have a negative interest rate. So I think rules have already evolved. And just to give you some perspective, in the S&P today, 77% of the value of the S&P is intangible. It is not, if you liquidated the S&P today, you'd only get 20 cents on the dollar. The value of most major brands today is built on trust. So here's where we come to store value. People think gold is the only store of value out there. We've published a piece earlier this month that really looked at what's the true store value. People use store value. Gold is one generation store value, but it's including collectible art, real estate, negative interest rate government bonds, and collectibles. That's a $280 trillion market is used today to basically park money, excluding financial assets. Bitcoin's $200 billion. If Bitcoin ends up just being 1% of the store of value in the future, it's $150,000 per coin. So again, from a mile away, I can see this value transfer towards Bitcoin and cryptocurrencies. So now let me jump to why Wall Street is going to care. So there's 3 reasons Wall Street's going to care. The first is there's a lot of money being made in the crypto space. The biggest exchange for trading financial assets today is ICE, Intercontinental Exchange. They own the NYSE, NASDAQ, and they're global. Thousands and thousands of securities traded. They made $1.6 billion last year. We estimate Coinbase could make $600 million this year. It's a cryptocurrency exchange, only has 4 currencies on it, and it's about 3% of global trading. In 18 months, Coinbase may be more profitable than ICE, and that is just mind-blowing. I don't think anyone could believe that ICE, the biggest exchange in America, could make less money than Coinbase, and that may be the future. So one, there's a lot of money to be made, and Goldman, Morgan Stanley, even ICE understand this, and I think they're building infrastructure into gateways into crypto. The second is that the crypto market is already large. It's $500 billion today. It would rank as the 20th largest country. So again, if you think about the emerging markets analogy, crypto is already the same size as Brazil, Spain, Singapore, Russia. It's bigger than Ireland, Spain, Israel, Greece, Turkey, Vietnam. Wall Street has thousands and thousands of bankers and research traders, everybody, and hedge funds dedicated to these other countries. This is going to start to focus on crypto. And the third reason is that as a portfolio strategy, crypto is uncorrelated alpha. Now, what does that mean? Take a look at this. If you look at each of those lines at the top, that represents the correlation of Bitcoin to stocks, which is blue, to bonds, which are red, gold, which is gold, and hedge funds, which is light blue. Bitcoin and crypto are uncorrelated to other markets right now. It is uncorrelated. That is almost a holy grail for portfolio allocation. And to understand why this matters, the bottom line on that chart is if you had a typical 60-40 bond equity portfolio. The line just above it is if you put 2% into Bitcoin. Your returns would have gone from 6% to 8%. And your drawdown would have actually been smaller, and your annualized vol is lower. Bitcoin reduces your portfolio volatility, believe it or not. And the top chart, that blue one where it went stratospheric, is a 5% allocation. So what we're saying is you don't need to bet your firm on crypto to see uncorrelated alpha. So with that, I want to just thank you all. We would be glad to share you with slides if you'd like it. Thank you very much.